Welcome to today's webinar, Digesting Proposed DAF Regulations. We will begin shortly. For any technical issues, please submit a message through the chat at the bottom of your screen or email us at webinars@cof.org. There is automated live transcript available if you click at the bottom of your screen and select Show Subtitles or View Full Transcript. This webinar is being recorded and will be shared with all participants and posted on our webpage as a resource. Finally, if you have any comments, please use the chat feature. At this time, I will hand it over to Jen Holcomb, our Vice President of Government Affairs and Legal Resources.
Thank you all for joining us today. We're really excited to have Eleanor on to walk us through these proposed regulations around donor advised funds. We're going to go through a quick overview of the proposed regs, but then really open it up for questions and discussion from you guys. So please use the chat if you have questions and you want to use the Q&A, or feel free to add them in the chat too and have a conversation there, because we want to hear from you. We want to hear how these are going to impact your work and the work of your foundations. So like I said, we are so honored that Eleanor Ramey is spending some time with us and is willing to walk us through what's in this, I think, like 60, 70 page proposed regulations. For many of you, I bet you know that she is a partner at Steptoe & Johnson, but she also worked on the precursor to these regulations when she was at Treasury from 2015 to 2020. So she's kind of our go-to person right now. In addition to myself, Ben McDearman and Eddie Shimkus and Nidal Zahir are also on the call. And you can reach out to any one of us as you are going through these regulations, you're having discussions, to tell us what you're seeing, what you're thinking, any feedback you are hearing from colleagues or partners or staff, because we're going to be creating our own comments that we send to Treasury, and we want them to reflect what you are seeing in these, how you think they're going to impact your work, and how we can, hopefully make them even better before any rules are finalized. So please reach out to us as you're having those discussions. And with that, I'm going to turn it over to Eleanor.
Thank you, Jen. It is great to be here. It is great to talk with people about these regulations. They have taken up a large portion of my life at various times, and so I'm thankful that they're out and that we can get the benefits of hearing of getting comments and hearing about them. So I'm very happy to talk about what they do, what they are, any questions that may be there. I can try to answer as much as I can about when I had worked on donor advised fund issues when I was in the government, but also just knowing that a lot has changed over a lot of years, and so this will be it's a great opportunity. So the first step is, what are these regulations and what aren't they? I think a lot of people have DAF regulations and they say, oh, well, there's going to be a payout requirement, or there's going to be something in this that deals with the sort of stickier issues. But these regulations are the definitional regulations. These are the regulations that are under Section 4966, and they provide definitions for what is a donor advised fund, what's the boundaries around it, who's a donor advisor, what are advisory privileges, when do you have advisory privileges, and what are taxable distributions. So that's the primary piece of it. What they don't provide are some of the issues that have been a little more controversial. They don't deal with private foundation use of DAFs. They don't deal with what is a more than incidental benefit, the issue of pledges and bifurcated payments. They don't deal with the public support issues, and they do not deal with payout at all. So those may come in future regulations, but that's not what's in these. So let's starting. What is a DAF? A DAF is a funder account that's separately identified by reference to contributions of a donor or donors that's owned and controlled by a sponsoring organization, and at least one donor or donor advisor has or reasonably expects to have advisory privileges with respect to the distribution or investment of amounts held in the fund by reason of the donor status as donor. So the bolded terms are all terms that are then that are defined more directly that we'll talk about here. So the first step is what is a sort of what sorry, I forgot about this slide. So the first step is, why does it matter? Well, what matters is if you have a DAF, if it is a DAF, then there's an excise tax on taxable distributions from the donor advised fund. So if improper distributions are made, then there's a 20% tax on the sponsoring organization and a 5% tax on fund managers. So that is that's sort of why it matters. So we need to know what it is a DAF to know then what goes from there. So the next question is, what is a separately identified fund? It's a fund that there's a formal record of contribution of a donor or donors, or it's a facts and circumstances determination. So that there's account balances that reflect contributions, dividends, distributions, expenses, gains, and losses. That funder account is named after a donor or a related person of the donor. It's referred to as a DAF in an agreement, or the donor by the organization, or that the donor has an agreement that says it's a donor advised fund. At least one donor regularly receives a fund or account statement, and the sponsoring organization generally solicits advice before making distributions. So that's what's separately identified. Who's a donor? A donor is any person, except for it does not include a governmental unit or a Section 501c3 public charity, except for disqualified supporting organizations, which is a very narrow definition there. So what does it mean what does that definition mean? That means that if there's no donor, then the fund is not a DAF. It's not a donor advised fund. So any fund that's solely funded by entities that are not donors, then it's not a DAF, and these rules don't apply. For example, a 501c3 organization, public charity, can set up a scholarship fund at a community foundation and not have to fall into the DAF scholarship funds exceptions because they're not a donor. So you don't even have the first step of the definition of a donor advised fund, because you don't have a fund that is separately identified by reference to contributions of donors, because it's a fund that's been set up by the C3, and that C3 is not a donor. So who is a donor advisor? A donor advisor is a person appointed or designated by the donor, or a person who establishes the fund or the account, and advises as to distributions or investments. So the donor advisor is sort of the person who sets up the account or is designated to be the donor advisor. So the idea would be that if you have like memorial funds or wedding funds, that the person who sets up that account may not actually be the donor. And so you would want, so that what this rule does is says that if that person has established the fund and has advisory rights to it, then they are a donor advisor, even if they aren't themselves a donor and there wasn't an explicit sort of designation by all the donors that contributed to the memorial fund or the wedding fund. The other piece is that a donor advisor, and this is one that has definitely gotten some attention, is personal investment advisors are donor advisors if they manage both the assets in a donor advised fund and the personal assets of a donor to that DAF. So if the personal investment advisor has both personal is advising both the personal assets and the DAF assets, then they are considered a donor advisor. That's not true if if the investment advisor is providing services to the sponsoring organization as a whole, not just to this one specific DAF or this one specific donor's donor advised funds. The effect of this definition is that personal investment advisors, if they are donor advisors, so if they fall under this rule, can't receive compensation from the donor advised fund. That pulls in a different code section 4958 that provides sort of limits the compensation that can be paid to donors and donor advisors, and just disallows it entirely. I'm trying to decide whether there's questions and whether, but I think we'll do those at the end. So let me get through it and then we'll go through the questions. And so there's also an exception for advisory committees. So in certain situations, a donor could say, create a fund it, and say, I want there to be an advisory committee that determines how this money is used. Donor, I'm not going to be on the advisory committee, but I want to recommend that somebody else be on this advisory committee. So the question is, when is that person a donor advisor? And the exception would be if the donor sort of is recommending somebody, if there's objective criteria, if there's a committee of 3 or more people, and the majority of them are not recommended by the donor, and nobody is a related person with respect, and the recommended person is not related to the donor. So the example of this would be a donor who sets up a scholarship or sets up a fund for scholarships and says, I want this to go to scholarships for children in this city, X city, and I want the superintendent of the schools to be on the committee that decides who gets the scholarship. That superintendent would not be considered a donor advisor because there'd be objective criteria, there'd be a reason that they were chosen to be on the committee that wasn't because they were picked by the donor. If there was a committee of 3 or more people and the majority were not recommended by the donor, and then that person's not related to them. So that's another exception of who is a donor advisor. Then you have, what are advisory privileges? So again, if a donor or donor advisor does not actually have advisory privileges, then the fund that we're talking about is not a donor advised fund. So then the question is, what are advisory privileges? What are the things that count as being advisory privileges? Again, this is a facts and circumstances situation, or at least the proposed rules provide facts and circumstances. It includes advisory privileges include the ability to be an advisor on an advisory committee. So just because it's a committee just because there's an advisory committee doesn't take it out of these rules of a donor advised fund. It is applied to the entire fund. So if one donor or a donor advisor has advisory privileges, then the fund is a donor advised fund, even if other donors don't necessarily have advisory privileges. This would be similar to the situation with a memorial fund or a wedding fund. There's lots of donors to that. Only one donor or 1 or 2 donors might have advisory privileges, but it's still a donor advised fund with respect to everybody. officers, directors, or employees of the sponsoring organization are not generally considered to have advisory privileges, even though they would obviously oftentimes may make direct grants, but that is not a they're automatically not considered to have advisory privileges under this rule. If a donor has advisory privileges, then it's assumed that those privileges are by reason of their status as a donor. So there's not this idea that, well, they're a donor, but they have advisory privileges because of some other reason. No, if they're a donor and they have advisory privilege, then that it's deemed to be by reason of their status as a donor. However, there's one exception to that, which is the other advisory committee rule, which is if that donor is appointed by the sponsoring organization onto the advisory committee based on objective criteria. There are 3 or more individuals on the committee and no more than 1/3 are related to each other. And the appointee is not a significant contributor to the fund. So the donor is a donor to the fund, but not a significant contributor to the fund or the account at the time of the appointment. Then that donor will not be determined to have advisory privileges based on their status as a donor, which again would make it so that that would not necessarily, that could pull that donor advised fund or that fund out of being a donor advised fund. So those are the pieces of who are the people who are making the funds, what is the fund? We then have what's a distribution, because once you know what a fund is, then the question is there a taxable distribution from this fund? So a distribution is any grant, payment, disbursement, or transfer from a DAF, but is not any investment or reasonable investment or grant related fees. And also anything that uses DAF and assets that result in a more than incidental benefit to the donor. So what this means is that in some situations, donor advised funds may have been purchasing goods or services directly from the donor advised fund. And this definition says that those are distributions. So those would have to fall under the requirements for making something not a taxable distribution or a non-taxable distribution, which practically means that the payment for the goods or services would have to be for a charitable purpose, and there would have to be expenditure responsibility done. So practically, I think that this shifts it so that instead of goods and services being purchased out of a DAF, that the money would be most likely would then need to be transferred to the sponsoring organization. The sponsoring organization could buy goods or services, but it's not coming out of from the DAF directly. The definition of investment brings in the possibility of program-related investments as being distributions, not investments, and so would fall under the distribution rules versus the investment rules. This is definitely a very broad definition of distribution, and it's different than the private foundation definition of distribution, where the focus is on which distributions count towards the 5%. And so the focus is much more on pure grants. So it's a different framework. A distribution is a taxable distribution if it's to a natural person, to any other person being individual or corporation or other entity, if it's not for a charitable purpose, or if the sponsoring organization does not exercise expenditure responsibility. That's the standard rule, but It's automatically not a taxable distribution if it's to an organization described in 170B1A, which is basically all public charities. The regulations do put in an interesting little side note that the distribution has to be for a charitable purpose if it's going to a public charity. So that would be the distribution could be to the charity, but if the distributions to the charity for, let's say, specifically for lobbying activity, that's not a charitable purpose, and therefore that would end up being a taxable distribution and not a non-taxable distribution. The non-taxable distribution includes distributions to the sponsoring organization of the DAF. So anything that goes from the DAF up to the sponsoring organization, and also any DAF to DAF transfers. Distributions to foreign charities are not taxable distributions if they follow the equivalency determination rules that are under the private foundation rules. There's a daisy chain anti-abuse rule, which is a provision that basically says that you can't make a distribution sort of in a series that then goes from a DAF that then goes to a disqualified recipient. So the idea that if I make a distribution or a recommendation to give money to my church, but then also have the power to distribute from my church to a specific named person, that would be disallowed because a DAF can't distribute to a natural person. And so you can't daisy chain it through another organization. So what is accepted from a DAF? So first of all, anything that gets a fund out of the definition that we had. So either the people that are donating to the DAF are not officially donors, and so that fund is now not a DAF, it's just a fund. If they don't have advisory privileges, if the fund's not separately identified, those are all things that pull a fund out from being considered a DAF. But then there are also some specific exceptions. The first one is the single identified organization. So this isn't a fund that would otherwise be a DAF. So it has a donor, the donor has advisory privileges, but the fund only makes distributions to a single governmental entity or public charity. So at that point, the donor advisor might be able to determine when those distributions are made, but they're only going to go to a single governmental entity or a public charity. Again, you can't daisy chain this, so you can't give to third parties on behalf of the organization, and you can't, okay, those are two things. One is you can't give to third parties on behalf of the organization. So this isn't a way of sort of having a supporting organization that can act sort of on behalf of the single identified organization. The money has to go directly to the single identified organization. And then you also can't daisy chain, which means that you can't have the money go to the single identified organization and then have advisory rights out of the single identified organization to somehow make it not a donor advised fund. Next exception is the disaster relief funds. These are broader than the employer disaster relief funds that used to be, that have been allowed since 2006. But it piggybacks on those rules. So there has to be a charitable class. So it has to be a broad disaster relief for a broad group of people. The selection committee has to not be controlled by donors or donor advisors or related persons. The majority of the committee can't include people in a position to exercise substantial influence over the employer if it is an employer-related fund. There has to be objective and non-discriminatory selection of the recipients and no more than incidental benefit to the members of the committee. The next exception is the scholarship funds. These are funds that are created in the sponsoring organization, but wants to give, or is intended to give money for scholarships, so to natural persons. And so that would normally be prohibited because donor advised funds can't give money to natural persons. The scholarship fund allows that if the advice of the donor is part of a committee, so the donor's on a committee and the committee is appointed by the sponsoring organization, the donors don't control the selection committee, and that there's non-discrimination, objective selection, and adequate records for the scholarships granted. And the final exception is a exception that was added based on comments that came in 2007 and 2008, which is for a lot of Rotary clubs and social welfare organizations asked about funds that they might have set up as scholarship funds at community foundations. And so this provides an exception for a broad-based membership organization. So a C4, the IRS and Treasury have asked for comments of what is broad-based. The committee can be chosen by the C4, so the committee to determine the recipients of the scholarship, but there has to be objective non-discriminatory selection. There has to be a big enough charitable class, and the scholarships can't benefit an officer, director, or trustee of the sponsoring organization of the fund or the account, or any member of the C4 organization or related persons. So this is sort of for community type scholarships. So that is, I think that's the last slide. Yes. So that's the last slide. There have been a lot of comments that have come in. And so,
oh my gosh, Eleanor.
So I am gonna I think.
Well, here, yeah. So I know Ben has been answering some of the more straightforward ones. We're gonna try to do this. There's been some suggestions in the chat, and we will do our best to compile all the questions and answers in what we send out, along with a recording and kind of a modified slide deck that has a little bit more information as we go through this. But I'm gonna start with some of these for you, Eleanor.
Okay.
And first, we've got Faith, who is asking, can you define related party? Is it family, close friends? Who's in that definition?
Right. So it's defined under it piggybacks the rules for 4958, which is actually broader than the self-dealing rules for private foundations, but is the same that applies to disqualified persons for public charities. So ancestors, descendants, siblings, and 35% controlled entities. So it does pull in the siblings, which is not something that the 4941 regulations or the disqualified persons under the private foundation rules pull in, but this one does include siblings.
Okay. Zach is asking if field of interest funds are redefined to be considered donor advised funds. Will that exclude the acceptance of qualified charitable distributions to that fund?
It should not. So qualified charitable distributions for private foundations?
No, I think they're talking about IRA.
Oh.
I think the answer is yes.
Yes. If it becomes a donor advised fund, then the IRA rollover provision would not be allowed to go into that fund. And so I think that's one of the things that's really important with comments here is really looking at the field of interest funds and how the advisory committees work for them and how they're set up. And if there's other exceptions that need to be addressed in the comments, or if there's ways to restructure field of interest funds to make sure that they really are field of interest funds and not donor advised funds. That's what the advisory committee rules, sort of exceptions in the donor definition of pulling out C3s, because if you're not a donor or donor advisor, if you're a C3, if only a C3 is advising off of it, then you're not a donor advised fund. But that's going to be something to look at in order to have really substantive comments to Treasury.
Yeah, I'll jump in. I just answered a question on a similar question on the QCD question. And I think it's important to step back and think this proposal deals with the definition of what is a DAF. And so it shapes our understanding of what funds may need to be classified as a DAF versus those that maybe we didn't think needed to be classified as a DAF before. But it doesn't change any of the other rules, like under section 408D8, the QCD rules themselves don't change. So the issue is it a DAF? If it is, it's still ineligible to receive a QCD. But the difference is a fund that you might have had not classified as a DAF before, under these regulations, if they are implemented as written here, you might need to then classify that fund as a DAF, or look at how to change the way that that fund operates to ensure that it does not meet the definition of a DAF.
Thank you for that. Yeah, exactly. And, as we have been talking about this, at the council, we really see this as kind of the setup for what potentially could come next. And so thinking about it in terms of making sure that we, get those definitions in a way that works for our community foundations, but also thinking about kind of the next set that could be coming down the pike too. Eleanor, one of the things, and you hinted at this when you were talking, and I know you and I have talked about, or we've all talked about it, is around the personal investment advisors. And we've got some questions, kind of just, if you could provide some clarification of to what, why that was included from your understanding or what you're thinking, and what community foundations and other DAF sponsors may want to be thinking about in their comments about, given the proposed regs on those.
Right. So the personal investment advisor issue is that if you have a donor or if you have an investment advisor who is being compensated based on the assets under management, both at for their the donor's personal assets and the assets in the donor advised fund. First of all, there's the potential that could reduce the fee to the donor, so there could be an incidental benefit. That's less of the issue here. Here's the primary concern. It was the idea that investment advisor has a financial interest in having more money in the DAF than less money in the DAF. And therefore, there's a potential conflict of interest with retaining funds in the DAF versus advising funds out of the DAF, which is ultimately the goal for funds to get sort of out being used in charity. Like that's the point of the donor advised funds. And so that conflict of interest is the primary concern, versus if the advisor is advising with relation to the sponsoring organization as a whole, then it's looking at the sponsoring organization's assets under management, not individual DAFs, and not the fact that this DAF has, because they're getting paid out of this one DAF, versus if they're providing services to the sponsoring organization as a whole, then whether one donor gives a lot of money in 1 year or not is not going to have a financial impact on the investment advisor. So that's the concern. Based on that information, the effective comments to Treasury in general are ones that address what the concern is, what the unintended consequences are, what the problem is, acknowledges the concern that Treasury and IRS express about this, and then finds an alternative that can address that in a way that is ideal, or is most effective for the commenter. So So those are sort of ways to think about it. Are there other ways to make this rule not as broad and still address some of Treasury concerns, but also address the concerns that community foundations and basically every DAF sponsor I've heard from that is concerned about this. So
I want to go back quick. I missed a question from Christine with respect to the IRA charitable rollover. And just making sure, she's asking, if there has been money from an IRA charitable rollover over to what was considered a field of interest fund, which may now be considered a DAF, will there be any penalty, or is this just going forward? And just clarify that this is, yeah.
The proposed effective date is that for taxable years that end after the regulations are finalized, which does actually have some retroactive effect, because if these are finalized in, let's say, next September, and your tax year ends in December of 2024, then the regulations would apply for all of 2024. So that may be also something to have comments on, of actually have it applied to tax years starting after the final regulations are finalized. But in general, otherwise, until they're finalized, it's not going to be retroactive, and it would only be potentially retroactive to the year in which, the taxable year in which they're finalized.
Philip is asking about lobbying. And what about a grant that has insubstantial lobbying expenses? Would that get caught up in the taxable versus non-taxable distribution?
Right. So the question is, how is that distribution being made for lobbying? Like, is it that this distribution is being made for a program that includes some lobbying? I think that would be fine. I think that the issue is when the distributions being made for the lobbying activity, or for a non-charitable activity. So I think it really would just depend on how the lobbying expense sort of fits into the grant.
That makes sense. We've got another question from Philip, who's asking about, can DAFs grant to a university for a scholarship fund managed by the university?
It can. The issue would be whether that donor then has advisory privileges for the scholarship fund managed by the university. Like, that's the daisy chaining issue, is that if the donor, now it may be impossible for the sponsoring organization to know this, and so that may be a comment to put in and say, like, as a sponsoring organization, we don't know whether the donor still has control or advisory privileges. But the concern would be if the DAF grants to the university for a scholarship fund managed by the university, but the donor is then on the committee to choose who gets the scholarship.
Given the broad Carrie's asking, given the broad definition of investment advisor, if a donor uses a big bank to manage their personal assets, and the same bank manages the assets of the DAF, over which the donor has advisory privileges, is the big bank a donor advisor to the DAF?
Under this rule, they could be, if the bank doesn't somehow have this is the only donor advice fund they do, or they're not one of the sort of things that all donor advice funds could choose from of managers too. So it's possible. I think that's, again, a place where comments might be really useful, of what trying to figure out whether this is not just Jane Smith investment advisor. Could be very large institutions. And so,
yeah, Eleanor, I think that also highlights a good question or point that I've been sort of looking at as I work through this as to whether, I know that one of the things that Treasury has requested additional comments on is how they would determine, or how they should determine, whether or not an investment advisor is specifically for that DAF versus for the whole organization. And I wonder if one way that organizations might try to characterize this as being not just for that DAF is if a donor recommends that advisor for their DAF, the foundation vets that manager and says, you're now available for managing other funds, not just this one, and makes them available for other donors to potentially choose to use as well. If that could somehow get them away from just being for this single donor advised fund, if they now say you're under our umbrella of approved investment managers, and it's not just limited to this one DAF.
Right, and that we'll give that out to all DAF
right
like holders. Yeah, and I don't know, and that would be something to put into comments of how to address that.
One of the questions I've seen, and I know we've got them in the chat, we've got them in the Q&A, and then others as well. So I'm going to just be honest, we are going to try our best to get to all of these, but and I'm trying to pick out broad themes. And I know Ben's answering lots in the chat, but if we don't get to them, we will try to get to everything in subsequent materials that we send out after this. But a question from Julie is, why exclude funds that only give to one organization? Why not exclude funds that provide a percentage maybe to different organizations? So, 5%, 10% here, 10% here, 10% here, but it's always that kind of same organizations. Or is that a place for maybe comments?
Right. So the single identified organization is actually a statutory, was in there as a statutory exception. And then there's a allowance for Treasury to make other exceptions. And so that would be a comment, that would be something I recommend of saying that there could be a way to make it so that it's not as limited as a single identified organization, but to also make it a little broader.
I'm going down here. Sorry. I had one picked out. You guys are putting it in so fast that it skips then when I find it. From Barb, advisory committee question: with the advisory privileges caveat of the appointee not being a significant contributor, how is that determined? And the definition of significant there.
Right. Yeah. That, I think that I'm trying to think whether whether the preamble actually says, I think generally 10% is seen as significant, 10 to 15% could shift to significant. If there's a desire for a bright line rule, I'm trying to think whether there was actually a bright line rule in it, but I don't think there is. I think that it really does just say significant. And so the term significant is used in various places in the exempt organization space. And so, no more than an insignificant amount of your activities can be lobbying, no more than UBIT rules, etc. So, I think it would follow that, and it's always hard to get a set percentage, but I think anything more than 10% would probably be something to be concerned or careful with.
Another question, under the daisy chain anti-abuse rule, what level of culpability would the sponsoring organization have to have? Would the sponsoring organization only be taxed if it knowingly participated in a chain of transaction that resulted in a taxable distribution? This is from Kristen.
Yeah, and I think that's a good question, is how much can the sponsoring organization know, and how much can't do they not know? What is the things they right now? If there is a taxable distribution, then it is a taxable distribution, regardless of whether the fund manager requires the approval by the fund manager requires a knowing requirement, but otherwise it's not necessarily that you knew. And so I think that there might be some real question of like how much due diligence does the sponsoring organization need to do? And I think that that would be something that's great for comments, is what is reasonable due diligence in that kind of setting of when you're, especially when you're giving to, if you're giving just generally to an organization versus if you're giving to a specific fund at another organization, or sort of where that due diligence comes in. So, but there's not anything specific in the regulations that illuminates that yet.
Christine just has a clarification that I see a couple of people have thumbs up, so I just want to, because I think, anyways, Christine, do the rules eliminate the ability to use expenditure responsibility for grants, both domestic and foreign?
No, you can use expenditure responsibility for grants, both domestic and you have to if it's not to a 501c3 organization or an equivalence determination. So
we have a follow-up from Rebecca asking for, please say more about distributions from a DAF. Say to a consultant, would that be considered a taxable distribution? And if instead of paying the expense from the DAF, the money is transferred to a sponsoring organization from the DAF, then the sponsoring organization pays the expense, then it's not a taxable distribution. And that's a big one. So if you need me to break it up, I can.
right. So if the consultant is like, if it's a reasonable grant fee, then it's not a distribution. If it's an investment fee, it's not a distribution. So if it's a fee for grants or investments, it would not be a distribution. There's not a lot of information. Like, what we know is that donor advised funds distributions to their sponsoring organizations are not taxable distributions. There is nothing in this that says that a distribution can't be made to the sponsoring organization and then the sponsoring organization use that for the benefit of the DAF or for the benefit of the idea being that the sponsoring organization would have its oversight and of how it's using its funds. And so there would be sort of another check on the use of that. So I don't want to say like flat out, yes, you could just sort of circle the money and like, as long as the sponsoring organization pays it. And because I think that there could be an attribution to the DAF if it really is just a straight payment. But in general, distributions to the sponsoring organization are not taxable distributions, and there's nothing in the regulations that qualifies that or says that money can't then be used for the benefit of the DAF or for the benefit of for what the donor of the DAF wants that to be ultimately used for. So
we've got so many more, but not a ton of time. I'm gonna try to find some more, or not find them, try to see if there's any themes we haven't hit yet. So Todd is asking, would it be okay for the donor to advise timing on distributions if the designated fund is set up to benefit only one designated entity, or would that still make it a DAF?
Oh, sorry, I was just typing an answer to that one.
You beat me to it, Ben.
You answer it, Ben.
Well, it's in the chat now, but yeah, that's the statutory exception that Eleanor talked about a few minutes ago. So that has been the law for really 17 years at this point. So if a fund has a single named beneficiary, and so it's not just a fund that happens to have granted just to one organization, it has to actually identify that beneficiary in the fund agreement. But if it's limited to just a single beneficiary, it falls outside of the definition of a DAF as provided under 4966. So in theory, if a donor had some advisory privileges with respect to timing or amounts of distributions to that one beneficiary, it wouldn't fall under the definition of a DAF under current law.
Right.
I saw there were a couple of questions around that C4 exception for the scholarships and why. Eleanor, do you have a sense of this? My sense is that this was really just the Rotary clubs were asking for this. And so it really was designed with that in mind. This is, there are funds
Okay.
that have been set up from Rotary clubs, and there was always that question of, can they be the advisory committee, or does it have to be independent because they're a donor to this fund? And so that exception was really designed for that group. But I think there's probably an opening for comments to say this should be expanded more broadly besides just C4s. That would be something to consider putting in a comment for anyone who feels strongly about that being expanded.
Yeah, I definitely think so. And the C4 piece is also that it's one of those situations where the donor advised fund or the community foundation sponsoring the scholarship fund is a huge benefit from an administrative perspective, because the C4 could set up a supporting organization, a 501c3 supporting organization, and have whatever control they wanted to have over it. And so to not have to force them to do that in order to be able to choose the scholarship recipients that they want to choose, then this provides an exception that allows for community foundations and other sponsoring organizations to be that without having to now create even more supporting organizations.
I know one of the questions we've seen a couple times, and I was actually holding this one till the end, is, just to verify, these proposed rules are just proposals, or just a proposal. But we know that Treasury is likely, how much will Treasury and IRS deviate from this proposal, do you think, in what's finalized? And when do we think we will see those finalized? And that's, I know, a loaded question. A couple people who've asked it have said that too, and I get it. But, take your best guess.
Right. So changes will be based on the comments. And so if there are a lot of comments that say this does not work, or this piece of it does not work, that having 2 advisory committee rules does not work, or the various things that are in there, there could definitely be changes there. I think in general, these are definitions. And so there might be some tweaks to the definitions, but I would not expect suddenly that the term distribution be redefined completely. But it might, depending on what the comments are. In general, once the comments are in, it'll take at least 6 months to finalize anything. And that's if sort of people are really moving on it. These are ones where the definitions are going to be really important for the next sort of round of regulations. And so there might be a little more push, or if there's a determination that not many changes are going to be made, they may be willing to put up proposed regulations on the other pieces before these are actually finalized. It really depends. But I never speculate on time, because I was convinced that these were going to go out in January of 2020, and they did not. So I don't guess anymore.
That makes sense. Well, and I just want to reiterate, again, the council, we're going to be putting together comments that really reflect, what we're hearing from our members in the sector, and all these questions are going to help inform that. But if you have reactions, if you have feedback that you and your colleagues or others are kind of sitting with and just talking about, let us know sooner rather than later. As we've said, comments are due January 16th. With end of year and everything else happening, that's going to be here before we know it. So the sooner, all of you can share with us kind of what you're thinking, or how these are going to impact your work, and all the grants that you are making, let us know, because we want to include that as we can as our comments come together. Ben, you have had a chance to kind of look through all of the questions. Is there one area or one question that has stood out to you that we should ask in our kind of remaining few minutes?
Well, I think it's sort of a crossover of a couple of related questions that I hope we can answer kind of quickly. A lot of the questions seem to get to this issue of, will a fund that we had not previously considered to be a DAF now have to be a DAF? So really, we're looking at field of interest funds that have a committee so the answer there is it really, I think, is the question will turn on to what extent is the donor playing a role in appointing or recommending individuals who serve on that. I have encountered, I think, some, in my time here at the council and talking with members, I've seen field of interest funds that are set up in a way that I can't really distinguish how this is different from a donor advised fund. And so I think these rules are really helping us get a clearer picture of this is the type of donor involvement that a field of interest fund can have and still call it a field of interest fund. Here's the line where if a donor is serving on a committee and they're recommending a majority of the members of that committee, and there's not some objective qualification for these people being on that committee, then we're going to need to consider it a DAF. So I think that's one area that I would point out. The other, and this is related, is on giving circles. Because that's an area that, there are a couple of, there are some examples in the proposed regs that seem to describe a giving circle. And the answer under that is this a DAF? Yes, it is. I think with a lot of giving circles, it really will come down to previously the guidance that we and I think other organizations had seen was that a lot of giving circles failed that first prong of separately identified by reference to a donor or donors. And now under this new guidance, it seems like, that's good that we have clarification, or that we will have some clarification on what that means, because I will say that's been the hardest one to really, when you're trying to do this analysis on these gray area funds of is it a DAF or not, to know exactly what that means. But I do think that given how broad that definition is applied under these proposed regs, that if they are implemented in a way that's similar, I think there are a number of giving circles that would need to be reclassified as donor advised funds given this guidance.
Well, Eleanor, any last comments you want to leave us with before we sign off?
I think that I'm looking at some of the questions, and there's definitely this question of like, how do distributions to the sponsoring organization work? And I think that that's going to be something that it's going to need to be figured out, just because sponsoring organizations do often give grants without doing expenditure responsibility, without doing, like, they give grants to natural persons, they do all of that. And so if that's sort of based on the advice of a donor, then it's from the donor advised fund, versus if it's a grant up to the sponsoring organization to do a project, and that part of that project is something that allows them to do it, then I think that it's a different situation. But I think that there might be some pieces there where figuring out whether it really is a distribution to the sponsoring organization versus a distribution from the DAF to the ultimate recipient will be part of it. But I really do think that comments are important. I mean, I think that I've been fascinated by all the questions, because I think that it really it's all of the different fact patterns of, is this situation, we have this situation, is this in or out? And then the question of, should it be in or out? Like, is it in or out based on these rules? And then should these rules change to make it so they could be in or out? And then how would we recommend doing that? And that's where the comments come in.
I just saw one other question with our couple of minutes we had left. I'd love your input on this, Eleanor. I thought this was an interesting one and not one I had thought about. It says donor would no longer include a public charity, which we understand, and that's, I think, typically understood to be a positive change by most DAF sponsors. But how would this affect DAF to DAF transfers if a DAF was funded solely by another sponsoring charity? So it'd be a public charity that is granting to another DAF. My sense of this is that there's somebody else involved who set that DAF up. There's a person, a donor, who set up a DAF at another organization and is requesting the transfer of those assets from a DAF at one to another. But do you read that any differently?
Right. And so then that person would be the fund creator, and they are a donor advisor by definition.
Right. So it's not the case that the DAF sponsor number one is establishing a DAF and is the sole donor to it in their own right. So I think that normally wouldn't fall under that exception, the way it works in practice.
Right. Because the donor, normally a DAF to DAF transfer means that there's then a donor, somebody has advisory privileges on the the
Right.
part. And
Yeah,
that-
it's not just the DAF sponsor is setting up a DAF at another sponsor over which it is exercising advisory privileges. I mean, technically it could do that, but I can't really see that happening.
Right. And at that point, it wouldn't be a donor advised fund because
Yeah.
the sponsoring organization is a public charity.
So much to go through. Well,
There's so much to go through.
thank you all for joining us today. Again, Jess put in the chat, Ben, my email, and our senior manager, Eddie Shimkis's email. Please reach out to us as you have questions or if you have thoughts. We, like I keep saying, we want to hear from you. So thank you so much. We will work to get everything out to you as soon as possible. Eleanor, thank you so much for your time and everything. Have a wonderful rest of your afternoons.
Thank you.
Thanks, everyone.